The Audit Committee has an important responsibility on behalf of company shareholders to oversee the financial reporting process and external audit. U.S. generally accepted accounting principles, commonly known as GAAP, serve as a foundation for confidence in financial statements due to their consistency, reliability, relevance, and comparability. But we also know that financial statement users value non-GAAP measures and believe when presented appropriately, non-GAAP can provide insights about a company's results of operations, financial position, or liquidity.
The mission of the Audit Committee is to oversee the integrity, the quality, the reliability, the credibility of financial reporting. It is financial reporting. It is not just financial statements. It is the continuous process of reporting financial information to the owners of the business. It comprehends the annual financial statements, the quarterly financial statements, the quarterly earnings release, the control over the financial reporting process, internal control over financial reporting and the effectiveness of that control. And it also includes things like non-GAAP information, which is part of the financial reporting process, business performance information, which is part of the financial reporting process.
The financials are meant to provide the shareholders with a clarity around what are the ongoing operations of the business. So whatever non-GAAP metrics or financials are presented have to be in the spirit of providing an alternative perspective so that shareholders can really understand what are the ongoing prospects of the business.
Given its role, the Audit Committee can act as a bridge between management and investors, including assessing management's reasons for presenting non-GAAP measures and the sufficiency of the related disclosures, and evaluate whether the measures present a fair and balanced view of the company's performance.
The importance of non-GAAP measures and the consideration of audit committees in financial reporting is certainly growing. On the companies with which I work, I feel pretty good that management is using non-GAAP measures to help in the understanding of the business. A couple of specific examples would be if you have various segments of the business and they're similar but not obviously exactly alike, to break out segment revenue, to break out a segment operating income, they are really technically non-GAAP measures. And if you do that, you're probably going to be fairly consistent about it from period to period.
One of the things that we look at is whether GAAP and non-GAAP measures are given equal prominence in the company's financial disclosures. And we also spend some time looking at things like whether the non-GAAP measures are presented and calculated consistently, presented clearly, and so on. There are a couple of questions that come to mind that the Audit Committee could ask management about non-GAAP measures. One of them is to challenge the basis for making determinations about what is recurring versus non-recurring. Another question might be what controls exist over the calculation and presentation of non-GAAP measures. And in particular, to what extent is management familiar with the SEC guidance on that topic?
Other topics that the Audit Committee should consider discussing with management include determining whether there is an internal policy that provides guidelines for determining how non-GAAP measures are generated, defining how the company makes changes to the non-GAAP measures they present, and the rationale for why they would or would not make changes, comparing or benchmarking the company to its peers, finding out what disclosure controls and procedures are in place.
The Audit Committee asking questions about the preparation of non-GAAP measures is an important area, and I think it is beginning with, how are we using these to better explain to our shareholders first and foremost, how they think about our business, similarly to how management thinks about the business. To the extent that it enhances the understanding of a business, particularly complex, multi-segment businesses, global businesses, there are going to be those times and those instances where it does enhance a user's understanding.
Non-GAAP measures are used by some companies as an input in determining incentive compensation. In these instances, It is even more important that audit committees and/or compensation committees be closely involved with the non-GAAP measures.
Compensation metrics often incorporate non-GAAP measures. So I think it's critical for investors to understand the trends in non-GAAP measures so that they have a better understanding of executive compensation and how, by the way, the executives are actually managing the business.
I think it's important for the audit committee to understand what are the internal operational metrics management uses to measure itself. So I try to align the metrics to the compensation committee because a lot of times they are the measurements management is compensated on. So it's important for the audit committee to understand what those metrics are and how consistently they are measured.
Audit committees can also use their external auditor as a resource by asking the external auditor what its responsibilities are for the non-GAAP measures, and whether that responsibility is different depending on where the non-GAAP measures are presented. Asking the external auditor how the non-GAAP measures the company presents compare to other companies' non-GAAP measures. Discussing with the external auditors what its views are on the company's non-GAAP measures, including whether they are consistent with their understanding and knowledge of the company's performance. Learn more about the Center for Audit Quality's 2017 roundtables on non-GAAP and how audit committees can promote transparency and consistency around non-GAAP measures in our report, Non-GAAP Measures, a roadmap for audit committees, available free of charge at thecaq.org.